Okay. Well, happy Black Friday to everybody. Hope you can all see my screen and hear me clearly. And we'll jump straight on in. It's again much like Hubert. I love to kind of talk a little bit off the cuff versus a canned presentation. So we'll talk a little bit about some theory at the beginning, and also jump right over to have a look at the live markets, because of course it is exciting stuff what is going on right now. And for all of you who follow TradeThirsty, again, you may have seen our video that we published on the TradeThirsty site actually on last week on Tuesday, where we said the market will crash from here. And anyway, just one of the recent alerts we'll be talking about tonight, this morning. Anyway, let's get going. Acorn Wealth is an educational company, not a registered financial advisor in any jurisdiction or province. So, of course, be aware that trading stocks and options involves risk. And just because I do some crazy stuff doesn't mean it's right for you. Always make your own decisions and speak to a financial advisor. Okay, so again, like, the whole point of what Acorn focuses on is systems. If there's anything that I've experienced as a coach, as a trader, it's that consistency is key, and to have consistency, whether it's income, whether it's capital gains, whatever it is you're looking for, you have to have a system that's consistent in order to get consistent results. It's just like in a business, you've got to have a strategy. How do you go out and reach customers? How do you, what kind of line of business are you in? If you're constantly reinventing yourself every single day, you wouldn't be very successful. And that's why, especially in trading, you need to have systems in order to reach those types of consistent results. And I've done it all. Hubert mentioned Fibonacci's Elliott waves and Ichimoku as three good systems that you can use for technical indicators that work. And he's bang on. You've got to pick a system, and you've got to keep it simple. Hubert's system, very simple, following those rules. And that's what I found. See, because I've gone through it all. I've been doing this since 2003. Acorn has been around for 11 years as of last week. And I've gone through it all. I've used $20,000 software. I've used data feeds, which cost $500 a month. I've had TOS, TC2000, Metastock, TradeStation, Gecko, WiseTrade, you name it. And I've had as many as 15 indicators on my chart at once. And what I found is that the best thing of all of that worked was some of the simple stuff I started out with 16 years ago. So we're going to talk about the simple stuff that really, really works. And I'm going to jump through some of those original slides here, because we don't need to talk about why the market's at risk, because we all know the reasons. We're heavily over leveraged. We've got more money being borrowed in the market than ever before, and price to earnings ratios in terms of valuations on companies, they're beyond levels that we've ever seen in our lifetime, or anyone's lifetime probably in this room anyway. So putting that aside, what I really want to talk about is how we can trade it, where these really exciting trading opportunities are coming from. But what I do want to make the point of is that you certainly need an edge in these markets. This could be perceived as a chaotic market or a scary market, but if you have rules and you have an edge, it is actually very well organized chaos, and this is an amazing opportunity to make money. So even if this drop in the market has hurt you, even if you were unfortunately on the wrong side of this recent drop, this plummet, the best way out of that is to cut fresh and say, right, what's going to be the best way to recoup those losses and make money going forward? And that may not be in the positions you're already in. So we're going to try and give you a fresh approach today with some ideas there. And that is often why people don't make money in general, because they just simply don't take action. And understandably so, it's very difficult to take action when you're a deer stuck in the headlights because you don't have rules telling you what to do. Yeah, and I spent some great time with a lady many of you may have heard of called Linda Raschke, and myself and Jeanette and Hubert and many others that you'll hear talk today. We were all down in Chicago for the Chicago Traders Summit, speaking at the event, and Linda was there, who's a well-published trader, one of the best traders in Market Wizards, and her comment was, look, your job is not to decide whether to buy or sell a stock. Your job is to pick a winning strategy that works, that is rule-driven, and then your job is to execute. You shouldn't have to think about whether you should buy or sell. If you have to think about that, you're probably making an emotional decision, because a rule-based decision should be quick. Is it doing this? Is it doing this? Is it doing this? It's a yes, it's a no, and then pull the trigger. And we'll be talking about large trades I'm currently in. I took a $100,000 trade 2 days ago, or sorry, a few days ago, a bit more than two, which was emotionally a big decision, but it was rule-based and it was very quick as a result. So we'll talk about what that position was, as well as a few others as well. How do we beat the algorithm, says Bree. We will talk about that. But yes, even after doing this for 16 years, I am constantly faced with emotions. So I'm not trying to stand up here saying that I'm some superhuman terminator that can take trades without emotion. No. I'm very passionate about the stock market. I love it, as Jeanette said. So it's, for me, I have to have rules, because if I don't have a system telling me what to do, telling me where my entry point is, where my exit point is, and where my stop loss is, I don't think we would have the success that we do. Right? So we need to avoid emotions. We need to have a strategy in order to get away from all of this noise, which is purely designed to make you do the absolute wrong thing. Because just remember, the stock market is not really there to help you. They're there for the 1% to make more. And they do that by you buying at the top and selling back to them at the bottom. So I guess the more exciting thing is that there is a much easier way than what most people do. Most people sit there and they look at the Fed numbers, and they look at the looking at quarterly reports and things like that. Look, I get it. I understand that there's value in fundamentals and so forth, but I'm not the expert. I'm not a fundamentalist. I'm not an economist. I'm not going to compete with the Fed Reserve's research, or I'm not a geologist. I'm not a pharmacist. I'm not going to look at a pharmaceutical company and decide whether their drug's going to be FDA approved or not. That's not my specialty, nor do I want it to be. That's a hell of a lot of work to go and try and outsmart the smart money and figure out who the next Google or Amazon's going to be, especially when I don't have 40 years in that industry to be able to make that decision. So not only are you're trying to fight an uphill battle to compete with them, but I guess you don't have to, I guess is my point. They've already done the research for you, and we can follow the smart money's footsteps to find great trading opportunities, both in where markets are likely to reverse or change direction, and as well in then locating individual stocks to trade. So to talk about that, in terms of the theory part of today, I just want to bring us back to a very, very basic question of if we're going to try and figure out how to make the most amount of money we can consistently in the stock market, let's ask a fundamental question of what makes a stock or the market go up or down, right? So at a very basic level, volume. Volume makes something go up and down. Like the old Aladdin quote, whoever has the gold makes the rules. Well, in the stock market, whoever controls the volume dictates the price. So who dictates the volume? Great question. Smart money does. A recent report from JP Morgan estimates that 90%, 90% of all of the volume every day we're seeing in the stock market comes from computer-based decisions, algorithms. And these algorithms are making decisions based on patterns. So 9 out of 10 trades that happen today will come from an algorithm deciding to buy and sell with no human behind it pulling the trigger. That is amazing, right? And it's not just day trading and high frequency trading. It's also managed money, because they also estimate that now 60%, 60, of globally managed money is also managed by similar patterns. So, I mean, if you want to look at following the system, you need to understand, to have an edge, you need to understand how 90% of the market makes their decisions, how 60% of managed money makes its decisions, right? Because, and these decisions are basically preset patterns, they're preset algorithms, and they're making a hell of a lot of money doing it. Now, the question earlier, I believe, was from Bree, how do we beat the algorithm? We don't. We're not looking to beat the algorithm at all. What we're looking to do is piggyback off of the algorithm. We want to look at when the algorithms are buying and go with it to detect what those symptoms are, those that fingerprint of when the algorithms are going to buy and sell, and what rules they use. The beautiful thing about it is that it's actually easy to see. The problem is that most people have been inundated with so much garbage that their vision is clouded. You know, they've got 20 indicators on their chart. They're listening to CNN and BNN and crazy bald guys on TV telling you, what's going on? This is what, dividend yields and non-farm payrolls and blah, blah, blah. I haven't watched financial news in years because I find whenever it does, I start losing money. The systems are actually surprisingly simple. And the two things we need to be able to see to make money using this system is to answer two very important questions. One, what is the pattern in the chart? Because that's where the 90% of volume comes from. That's where the 60% of globally managed money, that's how they're making decisions. They're looking at what is the pattern? And the pattern's going to dictate maybe many of the things you guys wonder about in your trading decisions, which is, where should I get in? Where should I get out? Where should I cut my losses? What is the probability of my success? Absolutely every single answer to those questions comes from the pattern, right? So that's going to be the first thing. And then the second thing that we need to answer then is to increase the probability even further. What's the smart money doing? And we're going to look at both those scenarios today. Let's just have a quick look here. All right. So when we go into keep it simple, the kind of KISS principle, the ultimate two top-down market decisions we're trying to answer when we're making our trading strategy is ultimately, one, what direction is the market likely to go? That's an important question to answer, of course. And then once we've found a high probability response of that, how do I find the highest probability stock or option setups with the greatest risk reward? That is ultimately the only two things we really need to know to be able to put together a winning strategy. So we're going to start by asking the question, firstly, of what pattern is happening right now in the stock market. So let's switch over to the live charts. One second here. All right. So let's go over to the S&P 500. So first and foremost, I want to take us back for a little history lesson, because where we're currently at is a very dangerous period. And what I'd like to do is take us back to the last time we were in a scenario like this, which was the crash of 2008. Now, just 1 second here. All right, there we go. So in the crash of 2008, the first thing we want to do when we look at a chart is to put on our detective hats and find out what system makes it go up or down. Very basically, what makes a stock or the market or whatever we're looking at go up or down? And to answer that question, there's a very important test we have to do before we do any kind of other analysis. And that is to figure out whether we are in an oscillating or a momentum chart. Because the two are absolutely categorically different from one another, as different as a long is to a short. So when I'm looking at a chart, I need to decide whether we are in a oscillating or momentum system. The difference is, if you are in an oscillating system, this means that the support and resistance that matters most, the system that is in control, that the algorithms are following, is one based on straight lines. So what's going to make the stock or index go up or down is when it hits those lines, right? And that causes it to oscillate, to go back and forth. And so if we then apply the trading 101, buy support, sell resistance, if we are in an oscillating system, you buy on the way down as it's falling to support. And because it's oscillating, it's more likely to reverse when it hits resistance versus breakout. The probability is it will break down versus breakout. So we also sell on the way up. Buy the drop, sell the rally. That's oscillation. The indicators we would use would be things like Bollinger Bands, Keltner channels, indications that we are at extreme levels. If you're someone who follows relative strength index, for example, you might look for that to be as close to zero as possible when you enter an oscillating trade. And those are the rules you should be following if it's oscillating. Now, if it's momentum, and I should say this, and the other thing is, if it's oscillating, moving averages do not work at all. That, you can flush them down the toilet. So if you're somebody who's been taught MACD and moving averages and things like that, and you try to apply it to an oscillating chart, you're going to lose money. Those are appropriate when we are in a momentum trade, and where the moving averages are now the system that is making it go up or down. And if we go back to this example, you can see that from of April 2003 all the way up until 2004, the moving averages were working. The stock was rallying, the index was rallying up, constantly pulling back to the moving averages and consistently breaking through them. And whenever it broke through a moving average, it bounced off the next one. In fact, if you look at that entire year, there is very few candles that even broke through those moving averages at all. That tells you you're in momentum. But as soon as that shifted, as soon as that changed right there, you can see that all of a sudden, the moving averages didn't matter at all. It was like a knife cutting through butter. Not only did the stock drop straight through them, but it easily cut back up as well. Can everybody see that? Can everybody see and on from that as well? those are two different systems. Excellent. Si, senor. All right. So once we've been able to then identify who's in control, then we know what kind of pattern we're looking for. So straight away, I start drawing a line between all the tops and all the bottoms, and a shape pops out at me. And this shape explains every single time the market changed direction, every single one. So now I have a shape on the screen. And following my rules, my process, I say, okay, what shape does that make? And the shape that makes is an upward channel. Now, for those of you that don't know, an upward channel is bearish. Typically speaking, over 67% probability is after 3 touches of support, that channel will break down. So a lot of people look at upward channels and say, oh, they're bullish. That's not how you're meant to trade patterns. See, patterns are a leading indicator that tells you, more importantly, not what's happened before, not what's happening now, but patterns are a leading indicator, one of the only leading indicators outside of perhaps Ichimoku, that predict what's happening next and tell you exactly the probability of that outcome, where exactly it should go, and all of those things you need to make consistent, confident trading decisions. An upward channel should break down. But what happens if we don't? What happens if we break up? Does that mean that the upward channel failed? Well, actually, what it means is that we're still preparing for a bearish move, except now we're dealing with a bubble on top where an even bigger, much more momentum-based system is about to occur to the downside. In fact, if you've ever studied patterns before, you might notice that if you've ever looked at the frying pan pattern, or a cup and handle, or a bump and run, where a stock drops and only out of a downward channel only to rally, well, that's exactly what we saw here, but upside down. This is one of the most powerful momentum patterns that exists. So the moment we broke out of that upward channel, we were getting ready for a nasty drop. And right here, there, in November, where are we? November 2007, Acorn was born. That's when we started this company. And one of our first webinars we did was we looked at this chart and said, I wouldn't touch stocks with a 10-foot pole. I would be short everything. This is a head and shoulders pattern on top of an upward channel breakout. Can everybody see that? So if you knew nothing about economics, if you'd never watched a financial news program in your life, if you'd never bought a house in your life and knew nothing about the housing market, if you simply understood these intricacies of patterns, you would have been able to say with confidence, the S&P 500 is in real trouble and we're going to break down. Let's measure that head to the neckline. We're going to break down to at least 1280. Then that would also break down through the channel support. So now we're in a primary downtrend bear market. You could have predicted all of that in January 2008, if not before. And look at what happened. That is exactly where the S&P 500 broke down to. Not close to, not around abouts, but exactly. And then we got another upward, another head and shoulders. So then we measure that one. Where does that tell us we're going to break down to? That tells us we're breaking down to 1,000. And that's exactly where we broke down to. And that then became the resistance where the S&P rallied into from underneath. And then on the bottom, look at what we got there on the recovery. An upside down head and shoulders, which told us the market was going to recover. Where to? To here, which was exactly where we recovered to. So if you want to say that patterns don't matter, just look at this example. The entire drop of the US stock market, the chaotic drop of the US stock market, was actually extremely well behaved and highly predictable because it was all based on the algorithms telling you what was going to happen on high probability patterns. And so, what I'm going to be talking about now in terms of looking at how we predicted that and also how we predicted the recent crashes, it's not rocket science. We don't have a crystal ball. It's actually just following the rules that are there for everyone to see, that anyone with any level of experience can learn and follow. So let's go to the SPY. Let's fast forward now to current day. Let's get live. 1 second, what's going on here? All right. So let's start with the weekly chart. Let's start with the zoomed out version. Can everybody see on the S&P 500 we have an upward channel here? And because your basic test, look at it. Can you apply this to futures? Absolutely. So look at that. We are dealing with a beautiful upward channel. So the macro pattern is bearish. The macro pattern on the S&P wants to take us, look at this, one touch. I'm glad my pointer's working. One touch, two touch, three touches. We've had 3 touches. Probability is now we're going to break down. That's what the rules tell us. Now, could they be wrong? Sure. But you don't worry about that. You can't worry about if the rules are wrong. Otherwise, why have rules in the first place? The rules tell us to short. The rules have actually been telling us to short since September. But regardless, let's zoom in and see what the smaller timeframes are telling us. See, once we identified that larger term upward channel, we can then look at what's going on inside it. And can everybody see once more the other upward channel? Can everybody see the channel there? The channel inside the channel. Right? So what was beautiful about this is once more follow the rules. 1 touch, 2 touch, 3 touches. Support was done. It was over. It was exhausted. We were just waiting for this thing to start dropping. And where was the point it started dropping? When it hit the top of the larger trend. Rules, simple. And that's when we hosted this same webinar. We hosted in September, and we said, be prepared at the beginning of October, we're going to have an imminent 12% decline. And what we said was the first target, right, there you go, measure the channel. The first target would be there, right there. And look at exactly where the S&P dropped to. Once more, not close to, not somewhere near there, but exactly. That's exactly where it bounced. That was our first short-term profit-taking target. And secondly, to reinforce the power of this system, let me just zoom in a little bit. Can anybody perhaps see the other pattern that's going on right at the top of that channel? For the gold star. Can anyone see it? It's a head and shoulders. It's a little bit tough to see because it's such a small time frame. But when you zoom into the hourly chart, there was a head and shoulders right there at the top. So you're at the top of the macro channel, you're at the top of the midterm channel, and you're at the top of the small time frame channel. All 3 time frames confirming. Now, as Hubert and Jeanette mentioned, I eat my own cooking. I do my own stuff. I practice what I preach, whatever you want to call it. And if you're going to learn trading from anyone, if you're going to spend even $5 with somebody, you should know that they trade their own stuff. I think that's important, right? So we did. So this is actually a screenshot from my personal, one of my personal brokerage accounts. So as you can see, I was confident enough in that system to take $130,000 short on the market, by buying that quantity of TZA, which is a triple short on the Russell 2000, right? So, and I wasn't even near a computer. I was sitting on a plane. I was flying WestJet to somewhere because I remembered I was I was getting upset that WestJet's in-flight internet had gone up by 300%. Anyway, so I'd logged into GoGo in-flight internet. I brought up my TradingView account on my cell phone, and I saw that the Head and Shoulders had rolled over, and I sent an email to somebody that could log into my account and said, you know, buy this. It was a 5-second decision because I knew what the rules told me. I knew what the probability was saying, and then also took an options position on my Interactive Brokers account because I could trade that from my phone, and put $8,200 into TZA calls, November, $10 calls, which we bought, as you can see, at $1.03, and had a rally all the way up to 264, which was a $14,000 profit on $8,200 in 2 weeks. So if you're an options trader, there's the other side of the coin, you know, because the rules said so. And if you look at the Russell 2000, which is what TZA is based on, you'll actually see that the Russell 2000 broke, you'll actually see that the Russell 2000 broke its upward channel long before. It broke down by October 11th. So what's possibly happening now on the S&P 500 is already happened on the Russell. Not to mention things like the Dow Jones Transports, which is also in a massive head and shoulders pattern after an upward channel breakout. That indicates a 20% decline in the Dow Jones Transports. The patterns are all over the place. It's beautiful, right? And you've got the macro upward channel as well. You've got a channel, a larger channel, and a head and shoulders. it's, you know, I mean, this stuff excites me, guys, because this is where you get really high probability trading opportunities. And so once more, going back to the SPY, you can see that there was the target. It rallied up and then dropped again. There was the second target. That's where we covered a lot of our short profits. That's where I sold my TZA. And then look at what happens. Because we are in an oscillating pattern, because we're in a channel, the S&P bounces off of that support, because that's what it does when it's oscillating. It oscillated back up, and then look, it crossed the 200-day moving average. Now, a lot of people said to me, John, why are you, on that day, I said, this is the top. On that day, on November 6th, November 7, we published another video saying, this is the market top. This is where you start getting short again. And everyone said, are you crazy? We just crossed back above the 200-day moving average. I said, well, you're not reading it properly. The 200-day moving average doesn't matter at all. It does not matter because we are oscillating, and the rules tell us moving averages don't matter if we're oscillating. The oscillating levels do, and we had oscillated straight into resistance right there. So last thing I'll talk about on the S&P is if we then once more zoom into an even smaller time frame and take a look at what's going on there, can anybody see the pattern on the 1 hour chart on the SPY? G'day, Edwin. I noticed that name. So where does that tell us the SPY is going? That tells us the SPY is going to 258. 258. Okay. And look, we rally up into the moving averages, rolled straight over. But 258, is that bad though? That doesn't seem like much of a drop. 258, that's not too far from where we are. Well, hang on a second. What would that mean to the pattern? Let's go back a second. If we drop to 258, that would be here, wouldn't it? And what would that mean for the pattern? That would mean we have broken down from the channel, and that would mean we're dealing with a potentially high probability of a 13% decline in the S&P. So am I short? Hell yeah, I am. The other position I just took was on the Qs. Hubert mentioned that about the NASDAQ. So when we started to see this breakdown occurring, we took another position. Again, 99 grand worth of SQQQ, which is the ultra short ETF. Because the reason I'm buying these ETFs is this is in my account that I can't short. So I use cash to go short using inverse ETFs in that account. So the SQQQs, again, we took a position at 1581. And as you can see, that's the chart on the SQQQs, currently at 1622. And this is a vehicle, obviously, to short the NASDAQ, which, as you can see, everybody, has broken down from an upward channel. One touch, two touch, three touches. You're out of there. Three strikes. Right? This is powerful stuff. And I noticed that I haven't mentioned once what's going on with midterm elections and all that kind of stuff, all the noise, because it doesn't matter. If 90% of the volume is going to go one way, that's where it's going to go. And the way to figure that out is by knowing these rules. And it allows you then to also make consistent decisions as to where to set your entries, your exits, your stop losses. We're back into the TZA calls. Again, actually, I'm still holding for disclaimer purposes. I'm back into the TZA calls. I now have rolled those over into $13 January calls on TZA, which had a 24-hour return of 1,600 on 72.50. That's up even more today. But as you can see, this is stuff we practice what we preach, I guess is the main point there. Okay. How could you distinguish that from a fallen angel? If it was a fallen angel, it would have to go above the channel. But even if it was a fallen angel, that makes it an even higher probability breakdown. So the target on the Qs, for example, would be down here to 150, and that's where I'll take some profit. But what I'm more likely to do is just simply lower my stop loss and just let the thing run. I'm what you would call a lazy trader. You know, one of my rules is not to take trades when the market's open. I do not trade during the day. With the exception of that trade I did when I was on the plane. Other than that, everything I do is pre-programmed. I pre-program my entry. I pre-program where I'm going to take a third of my profit, where I'm going to take another third of my profit, where I'm going to take the remaining profit. I pre-program my stop loss. Everything, the entire trade is programmed before I ever even get into it. Because that, for me, is what trading should be. It's about your money working for you. I hate sitting around watching the market all day because it makes me do the wrong thing. So with something like the Qs, I will take a third of my profit when it hits down here. But after that, I'll just lower my stop and just let it run as long as it wants to run until I get stopped out at a profit. Okay. So for the sake of time, because I usually end up running at least 15, 20 minutes longer, and we don't have that ability to do that today. But with this in mind, now we have market direction. now we can look for some real gems. See, I actually don't really like trading the indexes because it's a low probability trade. I mean, let me put that differently. It's not as high probability as you can get. So even though we have probability and everything going in our favor with the patterns on the index, it's still an index. It's an average. And when you go for an average, you're going to get average results because an average is made up of really good companies and really bad ones. So I would prefer, if I have a choice, to only be short the really bad ones. In fact, I prefer to hedge that and go long the really good ones and be short the really bad ones. You know, so like Hubert, I have a list of longs and a list of shorts that I'm happy to be in even today. So rather than shorting the market, in my account where I can go short in my Interactive Brokers account, that's where I want to find the really juicy individual stocks. Because not only can I then combine the probability of patterns, but I can then get the individual weakness of the stock, and I can also bring in the probability of smart money. So what's all that about, you may ask? Ah, another great question. Let's take a look. So what kind of trade would I be talking about when I say high probability setup? Well, something like this, for example, which is one that I'm holding short right now in terms of owning puts. So have a look at Parsley Energy. Parsley Energy actually peaked in May. When the highest this stock got was in May. So as the market went higher and higher and higher, this did not. This stock has been breaking down since May. So I've been actually alerting people to start shorting the market since June, because even though the market didn't drop till October, individual stocks started dropping. The really weak ones and really good ones started actually dropping around June. So Parsley Energy was one of these. And you can see here on the chart that this made a really beautiful head and shoulders pattern. Can everybody see the head and shoulders pattern there? Do I only focus on head and shoulders and channels, Bernard? Nope, absolutely not. There's 5 core patterns that I focus on. There's 100 patterns in the market you could look at, but we specialize in 5, which from the 16 years of research I've done are the best ones to look at and the easiest to find. Okay, do I use the same rules for each individual stock in ETF? Rules are, yep. I mean, ETFs don't have what I'm about to show you. But technically, yes, the rules apply to everything. Futures, Forex, cryptos, anything where money is at work, the algorithms are at work. And the algorithms all follow the same rules. Okay, so that is a, no, it's not a triple top. There's one candle, 2 candles that make it not a triple top. Now, I don't want to call the pot. I don't want to call anyone out, but I would be strongly against an opinion that this is a triple top or a downward channel, because those 2 candles went higher. The algorithms went higher. It doesn't matter for how long. What it tells you is, where does the price reverse at? Even if it's just for a few days, that's not random. And as soon as you start looking at the details, especially in trading, the devil is in the details, right? The devil's in the details. You've got to look for these things. They give you these really important clues. This is something we teach our students in terms of identifying patterns. It's a really, really cool way to do it. But anyway, head and shoulders, and this told us that the stock was going to drop. There we go. We measured the head and shoulders. This told us the stock was going to drop to at least where we're currently at today. So I bought 100 put contracts on Parsley Energy. I'm still holding 79 of them. I took profit on 20 of those this morning. And but this isn't just the only reason why it's so good, because one, we've got a very high probability pattern. It's one of the most powerful patterns for reversals in the bull market, which is a head and shoulders with a downward neckline. Ranks number 1 out of 100 for reversal patterns in the bull market. There's another reason, though, I also really like this, and this is where the smart money come into play. So this indicator I'm going to bring up on the screen is called Twiggs Money Flow. And Twiggs Money Flow is like Chaikin Money Flow on steroids. It was actually developed by a gentleman called Colin Twiggs. And what it does is it actually looks at all of the stuff one would look at when determining a real uptrend or downtrend. So uptrends or downtrends are typically identified as higher highs and higher lows, or lower highs and lower lows. Well, yeah, sure, but that's only one part of the puzzle. To have a real uptrend, to have an uptrend you would actually want to buy, it needs to have higher highs and higher lows, increasing volume, expanding range candles, and closing consistently in the top half of the range. If all of those things aren't happening, it could be a fake rally, a fake out. You could be about to lose a lot of money. You have to look at all of those things to have a real recipe of a true trend. And so Twiggs Money Flow looks at all of that and says, is the smart money buying or not? So when I start to see that as the stock is going higher and higher and higher, and I see that smart money is going lower and lower and lower, okay, 1 + 1 doesn't equal 6. Something's going on. And that tells me that smart money is selling from an algorithmic sense. The pattern tells me the algorithms are selling, and I have a high probability of success. And then last but not least, and you're going to love this, now we're going to consider the fundamentals. Now we're going to make this even more powerful by considering the news, the fundamentals, and everything. But, oh, wait a second. Didn't I tell you earlier that I wasn't somebody who read the news and I didn't care about fundamentals? I did, right? Well, this is the way I look at the news. This is the way I look at fundamentals. I don't bother doing any of that laborsome, tiring, and often incorrect research. What I do is I go straight to the source and I ring up the CEO and his board of directors and say, hey guys, can you tell me what your quarterly report's going to be like next month? Can you tell me if you're going to be FDA approved or not? Now, the way I do that, being a little facetious, but the way I do that is I ask them by looking at what they're doing with their own money. So when I go in and look up PE, and I see that the 10% owner, Brian Sheffield, just sold $70 million worth of his stock at 28 bucks, and so did 1, 2, 3, 4, 5, 6 other directors in the order of millions and millions of dollars, I say, something's up. And in combination of the algorithm, smart money indicator selling, and the highest possible pattern you can get for probability's sake, all saying the same thing, now I've got a slam dunk. Do I know what they do? No, nor do I care. What I care about is that my system and my rules now tell me I have a very high probability of success and to take the trade. So this took me about minutes to go from finding it to trading it. The question from William, why not start with the insiders? I do. So we've actually developed a scan that does all of this for us. So what I'm doing here for you is I'm taking you manually through the pieces of the puzzle that fit together to make the recipe. But now that, because anyway, I'm getting too excited. The cool thing about this is that now we know what we're looking for. We've now determined exactly what the finished product looks like. So now we can work backwards and develop it into a scan. So I always start with the insiders because the way that I sold the way that I find this trade, the way that I did find this trade was running a scan looking for stocks where all of this is happening. And so, all right, so we'll get to that in a minute. But yes, took this trade. There's Parsi. So yeah, bought 99. I thought I bought 100. I guess I bought 99. 99 puts at $1.05. And yeah, on $5,500, it was up to $10,382. Excuse me, $5,500 reward on $10,382. The current price, I think, is around $1.80. But I sold 20 of those this morning. 20 puts. I sold 20 of those. So not a third. I sold a fifth of my position this morning. Okay. So again, it's all systems, and it's all easy. It's keeping it simple. Anyone can do this, right? It's just a matter of following the rules. Take a look at some of the other stocks that we've also alerted here. ALGN. Take a look at this one. ALGN. Can everybody see the upward channel at the top? Look at that. Moving average is not working at all. Stock just crosses back and forth. So, hey, take those off. Flush them down the toilet. There you go. What's the upward channel tell us it's going to do? It tells us it's going to drop to at least there. That's exactly where it dropped. Look at the smart money indicator. Selling off as the stock goes higher and higher. Right? Cool. But is it just going to be a drop from from 400 down to 330, or is it going to be worse? Well, what about the fundamentals? Let's go and do our fundamental research. Oh, okay. The Senior Vice President and Global HR sold 89%. Then just a little while later, sold the 84% of whatever was left. You've got the Chief Financial Officer. They're not too confident because they're selling 82%. You've got the CMO, Chief Marketing Officer, selling 30%. And then the SVP Managing Director selling 52%. Who in their right mind would go out and say, hey, you're selling all of your stock? Great. I'll buy them off you, CFO. You're the Chief Financial Officer. You're selling 80% of your stock in the company that you know the books of. Great. Bargain. I'll take those off your hands. Of course not. But people do. So do we need to compete with the algorithm? No. Because there's so many ignorant traders that just don't know some of this simple stuff. And I was one of them for about 6 years. And if you're one of them, don't worry about it. Everyone's there at some point, but not anymore. So if you look at that, at $360 a share, 1 million shares traded, that's just on that day alone, $360 million worth of buyers who had no idea that the CFO and the CEO and all that were jumping ship. Right before, conveniently, it reports very bad earnings and the stock plummets to 200. Once again, this was something we alerted to our students. And you can actually, if you log into our members portal, which you'll all have access to after this workshop if you decide to take us up on our Black Friday offer, which will get you all of this, by the way, for $197. I'll talk about the exact offer in a moment, so just so you know, because we are running short on time. But if you log into our customer portal and go to trading alerts, this is the kind of stuff you'll be able to go back and have a look at. So I can go in and bring up, what is it? What were we looking at? ALGN search. And there you go. There's our first alert on it. October 5th, 349 was the entry signal. Target 1305, target 251. We have a second entry, which was at 235.95, 2 trade alerts. But yeah, have a look. You can see all the notes all of the notes on the setup of when we picked it, the timestamp of the video when we picked it, and really cool, you can actually even go into the chart and you'll see right here, if we magnify this, it'll show you exactly what the chart looked like when we picked it, as well as all of the analysis, and then you just click play. You can see what's happened since our alert. So that's a really cool way to learn quickly. Now I'm going to put the link to our offer in the chat box. It's acornwealthcorp.com/give, and let me tell you what that gets you, because this is this gets you set up with everything. As I said, we're all about systems, so we're going to be teaching you all the systems from the ground up. The first module, which is something that we'll be selling, well, which we have sold for at least it was $497 at the beginning of this year. It'll be going up next year. These first two modules cover all of the foundation skills. So there's 3 smart money indicators that we use to dictate market direction. We haven't even touched on those yet today, but they are. I mean, if you liked what I said today, these will blow your mind, and they are up to 93% accurate in predicting the S&P's direction 3 weeks ahead. Back tested 40 years. It will blow your mind. That's one of the 3 indicators. So we teach you these 3 indicators. We give these indicators to you. They work on any platform, and those will show you how to use them and what a buy or sell signal is, and that'll get you set up with understanding the smart money we use to make these market calls. And so that'll give you a 4-step plan so that every single day or week, depending on how often you trade, you can start out with a checklist to know exactly which direction the market should go with a very high degree of probability. And again, that's some of our secret sauce and how we've been able to call all of these market turns so confidently. Module 2 is going to teach you the smart money patterns that we look for. You know, how many bounces on a channel until it breaks. You know, how many bounces on a rising wedge. The different indicators we use for oscillation versus momentum. And very importantly, how to identify when a trend starts. So when to actually to start drawing the trend line from and how far back to go. All the key things you need to make confident decisions, because if you don't draw your trend lines correctly, you don't have any real chance of identifying the proper pattern, do you? And a lot of people struggle with that, even advanced traders. So we knock that one out of the park for you. And the purpose of these introductory modules, which again are $500 courses on their own, is to teach you all of these the foundational skills and indicators to set the stage for then being able to say, right, which direction are we going, and then scan for it. And so these 2 scans are all you need to find the exact same trades that I've just talked to you about today. A scan that looks for the insider longs, not just insider buying, but patterns, algorithmic buying, as well as the fact that you've got 3 or 4 or 5 directors buying, not just 1% or 2%, but insiders that are buying 500%, 600% more than what they owned before. Directors that are shorting 80, 90, 100%, getting rid of all of their stock. And we also include things like their debt levels, that they're heavily in debt. They have no cash in the bank. We combine all of that into the short scan, so you've got a real perfect storm. And then the smart money indicator. So that algorithmic indicator I showed you on the chart, that's in there too. The total value of this package is $1,100. So in the interest of TradeGiving and Black Friday, this is an awesome deal. And to make it one step better for you, when you enroll, you'll be receiving immediately my favorite setups for next week. And there's over 100 hours of research that me and the team did to put together a master list of our favorite setups that are actionable now, with options, entries, exits, stop losses, and all the research behind each setup, so you can put this to work immediately and make a very quick return on the 197 investment. So I'm out of time, guys. I told you I could go forever, so I certainly hope that I've at least been able to answer the majority of your questions. But if you do have any more that I haven't been able to address, let me just pop the phone number up on the screen. Excuse me. And there it is. (2676) info@acornwealthcorp.com. For some reason it wasn't coming up, but now it should be. There we go. There it is. That's lifetime access, Mary. You never pay another dollar for that course. You keep it for life. It's all yours. But if you have any questions, email me, because I don't want to take any time off of Serge. Serge is up next. Serge and I, he is awesome. I'm the stock and patterns guy, but Serge, I mean, he's got some awesome stuff. We were just in Vegas together last week. I'm excited to hear what he has to say. So I'm going to pass the mic back to Jeanette and tune in with the rest of you for the next presentation. I hope to see you all in the live lessons coming up.